Today on InvestTalk, we talked about high-yield savings accounts and CDs, talked about the market today, and then answered questions on RCL, how to balance a portfolio, and VRT, and rounded it off with a discussion on the new costs for passive investing.
This is InvestTalk, independent thinking, shared success.
Welcome back, and as promised, let's dig into our main focus point today and talk about high-yield savings accounts and certificates of deposit. Now, today's financial landscape offers some enticing opportunities for savers beyond equity markets with high-yield savings accounts and certificates of deposits, also referred to as CDs, providing interest rates that soar well above the national average, certainly compared to most people's local bank's savings account. So let's dig in a little bit and see how these options stack up and which might best suit your financial goals. Well, the first is high-yield savings accounts, or HYSAs, as they're commonly called, and they offer significantly higher interest rates compared to traditional savings accounts. The rate you earn, expressed as an annual percentage yield, or APY, includes the effects of compound interest, which boost the growth of your savings over time. The key advantage here is flexibility. HYSAs allow easy access to your funds without hefty penalties with no fixed term. These accounts are typically found at major banks and digital platforms alike. You can get them through your phone through Apple Pay. You can get them at American Express or use providers like Ally, and they're protected up to $250,000 by the FDIC or NCUA, ensuring that your money is safe. Now let's contrast that with CDs, or certificates of deposit. Now, these offer a fixed rate of return over a specific term ranging from a few months to several years. The rate is usually higher than what you'd find in an HYSA, and is guaranteed for the term of the CD, providing a predictable earnings path. Why is it higher? Well, accessibility is reduced. Accessing your money before the term ends usually incurs a penalty, typically costing several months worth of interest. CDs are a pretty good choice if you can set aside money for a longer period without needing immediate access to it, because it secures you a steady, predictable return, especially in a time when interest rates might be falling. Now, when deciding between these two types of savings vehicles, HYSAs and CDs, you need to really consider what your goals are and what your liquidity needs are. If you're planning to purchase something in the near term or prefer having flexible access to your funds, then certainly a high-yield savings account is where you would want to go. That's the path you would want to go down. On the other hand, if you have a lump sum that you won't need for a while and you're looking to maximize your earnings at a fixed rate, a CD could be more beneficial. With rates, like I said, potentially changing if the Fed's policies adjust, now might be a good time to lock in a higher rate with a CD if you had a specific lump sum of savings you didn't need to get access to. So whether you're saving for a dream vacation, planning for retirement, or simply building a financial cushion, understanding the nuances of these different financial tools can help you make a more informed decision and enhance your financial security and your financial growth. Let's talk a little bit about the market this week, but let's start with the market today. U.S. equities finishing broadly higher. The S&P and NASDAQ logged weekly declines while the Russell 2000 registered its fifth weekly gain of the past 6 weeks. Big tech was mostly higher. Other outperformers included home builders, rails, semis. REITs did particularly well today. There wasn't much that was negative, so the relative underperformers included energy, airlines, trucking. The overall index, S&P 500 up 1.11%, NASDAQ up 103, Russell 2 up 167, Dow up 164. Gold finished up 1.2%. Crude oil looks like settled down 1.4%, though off of worse levels and still notching another weekly decline. And the post-CPI rotational pressures on momentum growth tech kind of remained in evidence today. Risk-off has been the path of least resistance as of late, with the blame going towards a lot of factors: stretched long positioning, high Q2 earnings bar, which we've been talking about over the past couple weeks, and some scrutiny on whether or not all that CapEx on AI is going to provide anything towards the bottom line. That being said, the bullish case still continues to be made, mostly revolving around the disinflation traction and a eventual Fed pivot. June core PCE, which we'll get more in-depth on a little bit later, of 0.18%, a bit hotter than consensus, though the 3-month moving average of 2.1%, the lowest since December. Annualized core PCE in line at 2.6% and holding at its lowest levels since March of 2021. Bullish talking points for the weeks. What was good for the bulls? Well, rotation over broad risk off as the Russell 2 and cyclical value pockets of the market rallied once more. Soft landing narrative, as I mentioned, still largely supported by economic data. Inline headline and core PCE inflation provided further support for that September rate cut prediction. And the fourth straight week of inflows to U.S. equities. Year-to-date total now running at just under $200 billion. On the bearish side, there's a rotation out of momentum, which typically signals risk off, and that really weighed on the S&P 500 and the NASDAQ. First wave of Mag 7 earnings from Alphabet and Tesla were underwhelming, to say the least, really dragged a lot of the broader space down. That high earnings bar and AI scrutiny is still going to be in play over the coming weeks as we see more earnings from the Mag 7. The biggest one-day pullback in the S&P 500 occurred since December of 2022, and political uncertainty certainly ramped up with the announcement that President Biden will not be seeking re-election. Markets trying to digest that information as quickly as possible. Next week, looking ahead to next week, we got JOLTS on Tuesday, payrolls on Friday, and of course, the Fed meeting on Wednesday, though the decision is likely known as to what they will do. People will certainly be looking towards the comments to affirm if we can expect rate cuts this year and maybe the path moving forward heading into 2025. Let's go to our first caller question now.
Hey, Luke, calling about Roku, ticker symbol ROKU. I wanted to get your thoughts to see if it would be a good buy at this point. It's around 57 or so. I'm seeing support around 52. I wanted to get that validated by you guys as well. But I'm also seeing margin growth and revenue growth year over year. So that's definitely something enticing. I'd love to hear your thoughts on this and if it's a buy or if I should hold off. What you guys do? Thank you.
So the question is about Roku, ticker ROKU, super easy to remember. And you may know Roku as that thing that might come on your television, whether or not you knew you were buying it. And that's because Roku is a streaming service, app, platform host of sorts. And, recently on Wednesday, they reported some pretty dismal earnings. Peacock's, there were some declining subscriptions, which was bad news for Roku's channel with respect to Peacock. And so shares fell off about 10% on Wednesday. They since recovered a little bit. It's up almost 3% today. But let's dive in a little bit to the fundamentals. So they got about $650 million worth of debt on an $8 billion market cap company, which is a minimal amount of debt. Problem is, they're not turning a profit. Earnings per share hasn't been positive since 2021. It was $1.71, then negative 362, negative 501 last year, projected to be negative 182 this year and negative 115 next year. So not a lot of good signs there. Cash flow, though, has improved a little bit over the past year, but still it's not making any money. On top of all that, they're issuing shares. Going back to 2020, they had 120 million shares outstanding. This year, they have 145 million shares outstanding. And I think from a thematic standpoint here, though I do agree with you, there is some support at 52. It could certainly dip lower than that. I think my biggest problem is that it operates in a winner-take-all space. And as a streaming service, it's second rate at best. And so you're only as good as what you tie yourself to. And if Peacock's declining subscriptions is enough to hurt yourself as a channel, as a streaming service, and there are so many other options out there, I'm going to be frank. I have a TV that has a Roku platform on it. I don't even use it. I use a Chromecast. So I think that it is suffering from the fact more than anything that it is a second tier streaming service in a sector that is typically winner take all. On top of that, it doesn't make much money. On top of that, well, it doesn't make any money. On top of that, it has 10% short interest. I think the market's signaling here that you think it's low. It can certainly go lower. Thanks for the call. Now we're going to talk about a lot today. Going to cover a lot of topics. We also have some voice bank questions ready to play, one on General Motors, GM, and one on Lumen Technologies, LUMN, as well as some questions we're going to get to from our InvestTalk YouTube comment section. And of course, we welcome your finance and investment questions now or anytime throughout the show on 888-99-CHART. Now we're headed into a short break, and when we come back, we'll talk about today's market activity. Please remember, you can call anytime and leave your questions on the InvestTalk voice bank. Even if it comes to mind at 3 in the morning, it's there for you. You know the number, 888-99-CHART. Now let's head back to our InvestTalk question bank. That is our YouTube question bank. This one coming from our YouTube comment section from a frequent viewer. And his question is about HIG. Do you like HIG? It has good fundamentals and it is not overly valued, at the least based on price to earnings. So HIG is the Hartford Financial Services Group. And Hartford did particularly well with their recent earnings announcement, and the stock has reacted accordingly. Profits were up 35%. They also announced a $3.3 billion share repurchase program. And a lot of the profit increases, a lot of that growth was experienced through their higher property and casualty insurance underwriting gains, higher net interest income, and an improvement to the overall group benefits loss ratio, which is certainly good for this financial services provider and insurance provider. So the question becomes, well, they've run up a lot. Their growth looks pretty solid over the past couple years. Their net margins look pretty solid over the past couple of years. Their asset base is growing, which is certainly something we like to see with this type of company. So, along with their cash flow and profitability, how do they look fundamentally? Well, they have $4.3 billion in debt on a $38 billion market cap company, which is not that much. They've been buying back shares consistently. They have a consistent dividend of 1.84% right now. I say consistent because it modulates between 1.7 and 2%, but their payout ratio is 21%. So they certainly have plenty of room to cover that. And they're making money and they are growing. But is it cheap? Well, on a price to book, it's only 2 times, which is about at the high end of its range. And double what the industry average is. Forward-looking price to earnings, 9.5. I don't solely rely on price to earnings. You can't really solely rely on any individual valuation multiple, but it's modest, certainly, compared to other companies within that industry. So I would agree that it is not overvalued, but I think when you have a situation where you have significant run-ups post-earnings, then the announcement of a share repurchase program, which jolted the stock even more and gets it really close to what I would say a price target is, close to about 115. I would say take a step back. There's a lot of volume to the buy side on this name. Keep it on your watch list, but it seems to be a little bit overinflated relative to some news that has come this week. It'll probably tampen down next week and the week after and give you a good entry point. Thanks for watching. Now let's head over to the InvestTalk voice bank this time for a question that came in earlier.
Yeah, this is Will in San Diego, and I'm interested in General Motors. I know they had recent, reporting of their financial situation, and to me, a novice, it looked pretty much okay. So I'm wondering if now would be a good time to get in on the stock. I'll wait for your answer on the radio. Thank you.
General Motors, GM is the ticker. Super easy to remember, is a car manufacturing company headquartered in the beautiful state of Michigan. They did have a recent earnings announcement. They reported over a 60% increase in adjusted earnings per share to $3.06, far beating expectations, but sometimes beating expectations on the bottom line isn't enough to make the market happy. The stock did fall off, and that's because they mentioned how much issues they've had within the Chinese market. They faced a $104 million loss in China, though previously their guidance suggested that they would be positive in China. And so the strong results within the internal combustion segment wasn't really enough to, even though it did increase their EBIT margins, it wasn't really enough to beat down some skepticism about their current growth trajectory. They got a bunch of debt, $122 billion worth of debt on a $49 billion market cap company. They do pay a solid dividend. For me, I think this is a growth story. If you listen to us, you generally know we don't like car companies, but they're banking a lot and have been banking a lot on the growth of their international segment. And if they can't pull the Asian market segment into positive territory, which it doesn't seem like they have yet, I would still wait and see. I'm not sure that it's going to rally much beyond this point until there's more guidance on them actually being able to grow as they said they would in the past 3 quarters. Let's go to Jason in North Carolina, who has a question about RCL. Do you own it or are you looking to buy it?
I was looking to buy it. They had earnings yesterday, and I was wondering if you took a look at their balance sheet, what your thoughts were. They took a pretty good, about an 8% decline yesterday after their earnings report, which was very good. They reinstated their dividend, and it seems like they're doing well. I was just calling to see, do you think this is an overpriced stock, or is this a opportunity to buy in?
Yeah, let's dig in. RCL is Royal Caribbean Group. They offer cruises worldwide. And as you mentioned, they did report earnings on the 25th of July after market close. It looks like they beat by 16%. They had a positive surprise on the bottom line on revenue. They beat by 1.5%. So that alludes to them reducing costs, which is certainly good. Looks like they had some explosive growth coming out of the pandemic. Certainly, pre-pandemic, they were doing about $10 billion in revenue during 2021. Obviously, in 2020, they did. Actually, I'm pretty surprised. They actually had $2.2 billion in revenue in 2020 and 1.5 in 2021. That's pretty surprising. But that's gotten back up. Last year they did 13.9. This year they're projected to do 16.4. They were up about 1% today, and year to date they're up 18% on the 52-week, up about 52%. Now, this company at its core does vacations. It sells vacations to people, but it sells affordable vacations to people. I remember going on cruises when I was a kid, and it was an easy way for a family to do a international trip. I lived in Los Angeles, going down to Mexico, going through the Caribbean. It was an easier way for a family to be able to afford a vacation. It's a very cost-effective way to do it if you're looking to do that. And so certainly during the pandemic, it didn't do well. People weren't going on vacation. Coming out of the pandemic, it's done very well. I'm actually surprised at how well it's done in terms of the revenue growth there. Its margins look pretty solid. 12% last year, projected to be almost 20% this year. This is indicative to me of a company that's doing a very good job reducing costs, reducing overhead. Now, is it fairly valued? Well, it's trading about 7 times its book value, which is pretty expensive relative to its 5-year range, but a lot of this is going to be muddled by the pandemic. Price to cash flow, 9 times. I think that's still pretty fair. Price to sales, 2.8. I think that's pretty fair as well. Price to earnings, 12 times. I think it's fair. I think it's at a relatively fair price, if I'm being honest. I would probably wait, until next week. I typically like to stay out of trading names between earnings periods, about 1.5 weeks on either side of it, because you got a lot of people crunching a bunch of data. It can easily move against you. It can be very volatile. But certainly I wouldn't say that this is an overpriced company. And I'm, again, surprised at how well they have snapped back to profit. Thanks for the call. Now, on the next Invest Talk, we'll look into this story. Musk's $5 billion bet, Tesla to fund his XAI startup. Elon Musk proposes a massive $5 billion investment from Tesla into his AI startup XAI, subject to shareholder approval. The bold move could reshape the AI landscape and Tesla's future, as XAI aims to compete with tech giants like Google and OpenAI. That's Monday, but for now, I'm Luke Guerrero, and I'm ready to take your calls at 888-99-CHART. Now, I'm sure you can always tell that on Fridays I have an extra pep in my step, and that's not just because it is almost the weekend, but also because I love giving you a quick rundown of key benchmark numbers. The 2-year Treasury yield was at 4.387% today. For perspective, last week that was at 4.515. 37 weeks back, it was 5.05, and 135 weeks ago, more than 2 years, it was at 0.64%. The 10-year Treasury yield was at 4.201. Last week, that was 0.242. 37 weeks back, it was 4.63, and 131 weeks ago, that was 1.762. Gold was priced at $2,383 per ounce today. Last week, that number was $2,400, nice and round. 37 weeks back, it was $1,935. 125 weeks ago, it was $1,806. Silver today was at $27.80 per ounce. Last week, that number was at $29.21. 24 weeks ago, it was at $22.80. And 118 weeks ago, it was at $23.94. Oil was selling for $76.78 a barrel today. Last week, that number was 80.13. 33 weeks ago, it was $74.30. And 133 weeks ago, it was $66.62. The national average for a gallon of regular gasoline, that's $3.51 per gallon, a 1 cent increase over last week. 60 weeks back, that was $3.56. And 128 weeks ago, it was $3.57. In California, it was averaging $4.65 per gallon, down 5 cents from last week. 39 weeks ago, it was $5.32, and 115 weeks ago, it was $5.87. For comparison, in the state of Mississippi, today gas was averaging $2.98 per gallon. That is $1.67 less per gallon than gas is in California. Now, shifting gears, but in a same sense related, let's talk about PCE. In Washington this week, fresh data from the Commerce Department indicated a moderate increase in U.S. prices for June, with a rise in service costs partially offset by declining goods prices. The Personal Consumption Expenditures Price Index, PCE, the favored metric of the Fed, is a pretty critical measure of inflation, and it edged up by a mere 10 basis points last month, maintaining the trend of tempered inflation. Notably, the price of goods fell by 20 basis points, while services costs saw a slight increase of 20 basis points, offsetting each other. While certain areas are experiencing price hikes, overall inflationary pressures are easing. Notable decreases were seen in motor vehicles and motor vehicle parts. That dropped by 60 basis points. Furnishings, durable household equipment continued a 3-month decline as well. Energy prices also fell significantly, gasoline prices down 3.5%. On the services front, costs rose modestly, driven by housing and utilities, but the pace of these increases has slowed, which is good, offering a silver lining for consumers facing higher living costs. Consumer spending growth, which is a major driver of the U.S. economy, slowed last month, increasing by just 0.3% compared to 0.4% in May. Now, with inflation moving closer to the Fed's 2% target and hiring slowing down, the labor market deteriorating, we talked about that the other day, a historically strong labor market snapping back to reality, there's still growing anticipation that the Fed might cut interest rates in their next meeting, or rather in September. The potential shift in policy is maybe a necessary adjustment to support continued economic growth while ensuring inflation doesn't spiral out of control. Following the recent release of the data, the Treasury yield dipped, indicating the market certainly thinks that there's a cut on the horizon, and the dollar weakened slightly against other major currencies. Now, this latest report paints a similar picture to what we've been seeing, an economy that is gradually stabilizing since it's come out of the pandemic, with fiscal measures helping to temper inflation, monetary policy helping to temper inflation without stifling growth. So as we look toward the Fed's upcoming decision, as we look towards their meeting next Wednesday, we certainly will be looking here at InvestTalk for clues towards what the path will be, how quickly it will come, and what we can expect for the rest of the year. Now let's go to Tracy in San Jose, who has a question about balancing a portfolio.
Yeah, hi, thanks for taking my call. I'm trying to see how much, what percentage would you allocate to the high-tech sectors? I mean, right now, I have about 12% in the high-tech sector and for individual stocks, and about 13% for SPY. And what would you recommend?
Yes, that's a good question. You know, I like to use the market as a reference point for a starting point, right? So if you're building a portfolio, you're constructing a portfolio, I like to say, what does the US market look like? And so if you look at the Russell 3000, tech is about 37% of it. Now, once you know what the market looks like, that's when you start making your active weight decisions based upon your opinions, right? Is your investment philosophy tilting towards value? You would probably want to go lower on tech. You'd want to go higher on industrials. You'd want to go higher on financial names, so on and so forth. But I think a great starting point when constructing a portfolio is looking at the market overall. So you said that you have 12% in tech, and then what's your weight in the S&P 500?
Yeah, well, I have an individual stocks, about 12% in tech, about 13% in SPY.
Okay, so if you have 13% in SPY, then that means that you have roughly 17% of your overall portfolio, based upon your description to me, is in tech. So that means you are currently 20% underweight the market as a whole in tech, which I don't think is crazy. I think that what we've seen is this rotation out of tech into some of those small value names. The momentum's falling, growth is falling, value's doing very well. But you should be aware that you're pretty underweight tech relative to the market. I tend to want to stick to 10 to 15% on either range. So that would be bumping up your tech exposure by roughly 7%. But again, market dynamics are kind of telling us that there's a little bit of a rotation out of here. But I would still say that you're a little bit underweight tech relative to what I would be in your situation. But that's only about 5 to 7% there. That makes sense?
Okay. Yeah.
Great.
Thank you so much.
Yeah, thank you. Looks like we got another call, this time from Robert in Pleasanton, who has a question about VRT.
Yes, good afternoon, Luke. I've been keeping an eye on this stock for a while, and just want to get your thoughts on it.
Absolutely. I feel like we've had some questions about VRT recently, or maybe it was part of InvestTalk Market Madness, and that's why I know the name. So VRT is Vertiv Holdings. And Vertiv Holdings designs and manufactures digital infrastructure technology that cools data centers, cools data processors, and helps store and transmit data. It looks like they reported earnings on July 24th. How'd they do? Positive surprise, 17% on the bottom line and 40 basis points on revenue. So costs have been falling. Year to date, they're up 60% on the 52-week. They're up 204%. Certainly had a good trailing 1 year. Now, on a relative valuation basis, they are well above their 5-year trading ranges here. Price to earnings 26 relative to 18.5. Price to book 18 times. Price to cash flow 26 times. Price to sales 4 times. I mean, it seems like a name that's been doing well. Certainly, that's an evidence by their most recent earnings report. I haven't had an opportunity to dig into their forward-looking guidance, so I can't tell you what it looks like going forward based upon those earnings. But I will say, and again, relative valuation is a way of saying, is a company under or overvalued relative to how it usually trades? That does not tell you if a company is going to continue to trade higher, right? And so I would say, from my perspective, looking at it real quick, it seems as though it's trading well above those ranges, probably related to those earning beats. And so if you were looking to add now with earnings beats and what I imagine is elevated guidance, because their earnings per share projections look like they've been going up over the past 3 months, I would say, as I said to a previous question, give it a week, see how the market's digesting some of its new news. I think its growth is certainly something that is good. Its margins are improving from 2.4% in 2021 to about 12% of what they're projected this year. So all I'm seeing on the bottom line looks pretty good, very minimal debt. But the digestion of that recent earnings report probably is going to give it some elevated pricing over the next week or so. And so I would probably wait till it comes back down closer to a price to book of at least 14. Its 5-year average is 9. So let's call it 10. So closer down to 14 is kind of where I would want to get in there. 26 on price to cash flow is very, very expensive. Thanks for the call. Now I want to briefly mention our newest KPP premium newsletter will be distributed tomorrow because tomorrow is Saturday. This week in the KPP Insight section, we will be talking about tariffs. What is a tariff? We've been hearing a lot about tariffs from both sides of the aisle. What are product-specific tariffs? What are wider tariffs? What are the effects of tariffs? Who pays the cost of tariffs? And what does it mean for you? In the stock ideas section, we mentioned a staffing company as well as a media company. And in the portfolio management section, we touched on dividend investing, which I believe we did a webinar on recently, if you want to go check that out. If you're interested in learning more, visit us at investtalk.com and subscribe. The newsletter will come to your inbox on Saturday mornings. Here's another question from our InvestTalk YouTube channel, this one on Paccar, PCAR. It says, do you think PCAR stock is a buy after the recent pullback? Have had it on my watch list for a while now. Thanks. So PCAR is Paccar Inc., and they design and help manufacture some of the construction equipment trucks for Kenworth, Peterbilt, some of the big brands. They also provide the parts for them as well. They most recently had an earnings report on the 23rd of July. Looks like they were down about 30 basis points on earnings per share, and also was a negative surprise for revenue as well. Their guidance was also adjusted downward. And so both sales and revenue looks like has declined year over year. Yeah, sales is set to decline year over year by the tune of about $3 billion. And, I took a look at their guidance earlier, actually, the previous quarter, because this quarter they actually didn't provide any updated guidance at all for the rest of the year. And I think the big problem here is that although their Class 8 commercial truck market, their share is improving, the market overall within that segment has been shrinking. And so that's one of the reasons why you're seeing their revenue falling over the past year, even though, keeping that in mind, over the 5-year period, they've had 8% growth. And that's all to say that you're in a situation now where growth seems to be drying up, which is interesting at a time when business inventories have been increasing. And so for me, it seems a little bit elevated right now. From a debt perspective, I don't think they have too much debt. I think they got $5 billion of debt on a $57 billion market cap company. But with compressing margins and falling revenue growth, I think I would keep this on my watch list for now. I certainly wouldn't let it graduate to my portfolio just yet. Looks like we got plenty of time, so let's grab another InvestTalk voice bank question.
My question is, if an insider purchases $5 million worth of stock, but his net worth is $650 million, does his purchase tell you that he has serious conviction in the stock, or does it tell you maybe he bought it only for cosmetic purposes? Assuming all things are equal, would a $5 million purchase from an insider catch your attention? Thanks. Love the show.
$1 million purchase from an insider who is worth $600 million tells me nothing more than that he purchased $5 million worth of shares. I think sometimes too much is made of insider transactions. I would find it odd if there was an executive who decided to purchase shares on the open market rather than just have it part of his compensation package, but that's another part of it. But let's look at the other side, right? If insiders are selling shares. Well, certainly if I worked for NVIDIA and I had stock grants over the past 10 years, I'd be selling it at the highs too. If I'm Jeff Bezos and a lot of my net worth is tied up in Amazon stock, just because he is selling down, is that an indication that he doesn't believe in the Amazon stock? Or is that just an indication that he is trying to spend some money? I think too often people try and use insider transactions as a signal, and a singular signal rather than a complementary signal. And that's not to say if you have a bunch of insiders that are selling a bunch of shares, then maybe there's something going on there. And on the counter to that, I actually think that having compensation for executives be tied to stock-based compensation is a good thing. To a certain extent, it can be bad if the vesting period is too early. It can disincentivize longer-term growth relative to short-term growth, right? The whole idea of managers, of corporate managers, is you want to incentivize them to grow the company long-term. But giving a stake in the company to those people that run it, I think that's a great idea. So don't read too much into it. It can mean something. Oftentimes, it means nothing. Thanks for the call. See if we can go back to the InvestTalk voice bank and answer, or at least play another question that we can get to after the break.
This is Dan from Wisconsin. I have a question for you regarding One Main Holdings. Symbol is OMF. I do not own it. It looks really good to me, and I would like to purchase this. Let me know what you think of the stock and what might be a good buy point. Thank you. Bye.
Thanks for calling. One Main Holdings, ticker OMF, is a consumer finance company. So they do origination, underwriting, servicing, personal loans. I think we have gotten questions about One Main Holdings before. It's a very well-known company. It's a mid cap, about $6 billion market cap. And their net income has been pretty flat over the past couple of years. Interestingly enough, I can't really see anything about their growth, their revenue growth from earned interest over the past couple of years, but their net income itself has been pretty flat since 2021. Year to date, They're up about 8% on the 52-week. They're up almost 18%. So when we come back from the break, we will dig into more of the fundamentals of this company and give a recommendation for whether or not we like it or not. I'm Luke Guerrero, and we hope we have one goal here, and that is to help you achieve your financial freedom. Our work continues after this break. Get your questions in now before we head off for the weekend. So before we headed into the break, we were talking about OneMain Financial. And although their price appreciation over the past year has been pretty solid, 17%, my issues with floundering net income growth. Earnings per share has been falling since 2021, which is not something you want to see. Cash flow has been improving, but profitability has been shrinking as well. They had a lot of debt, $19 billion on a $6 billion market cap company. They also pay a dividend that's about 8%, but their payout ratio is 75%. So it seems a little stretched to me as well, especially with compressing margins and compressing earnings. So on OneMain Financial, OMF, I would have to pass. Thanks for the call. Now let's go to Bill in Northern California, who has a question about BMY. Do you own it or are you looking to buy it?
Hi, Luke. Yeah, I own it. I've bought it. I don't remember the exact time frame over the last, mostly this year. I bought it maybe 5 different times, a few hundred shares now. Yeah, mostly in the mid to lower 40s. And this big jump today, and I just, it seemed like a really good dividend stock, and it seems to me like a company that just needs, more product to really get, moving up the ladder again. But it just seemed like suppressed, so it seemed like a good time to buy it. And but you're just overview of the company in general.
Yeah, of course. Well, I actually remember a recent question about this company, and you are right that they do need more product. Because the biggest issue that this company faces is that it has a patent cliff coming in 2026 and 2027 that is going to be a big hit to a revenue to the tune of, products that have garnered them $12 billion. And so with that being said, I think that's why you're probably going to see a pretty tight range that it trades in before it makes new highs. It's trading at a price to earnings of 11 times. It's trading at a price to book of about 5.6, which is well above its 5-year average, which is 4 times. Its price to cash flow is below, and its price to sales is pretty even on. But I think the biggest problem here is you're talking about really an issue with what you find with a lot of these types of companies, a lot of these biopharma companies, is when you hit a patent cliff and your big source of revenues is coming down, like what is your next move? And so I think you nailed exactly what the issue here is. They need to have products to fill that gap that's going to come in the next 2 years. Will they? Your guess is as good as mine. I think I don't see any reason for it to imminently fall. I think all of what I've said is pretty well priced into this. I will say though, it's pretty significant, earnings beat today, to 27% on earnings and 6% on revenue. Pretty big pop today as well, up 11%. I would be looking to take some profits, especially if you bought it in the 40s. Thanks for the call. Now, we don't have much time, but I wanted to touch on an interesting aspect of passive management. And Vanguard actually brought this up. And they're going to have to update their disclosures in numerous funds because there's going to be a heightened risk for potential enforcement of longstanding caps on holdings. Traditionally, funds could exceed the 10% ownership caps without additional responsibilities, but the FDIC and other regulators are considering stricter enforcement of these limits. Now, these funds are large. They have large size and they have large ownership. Activists on both sides have been weary about how much power companies like Vanguard and BlackRock hold over corporations generally. And so if regulators start enforcing these thresholds, Vanguard is going to be forced to divest from some of its holdings. And some of these changes could increase fund expenses, affect performance, potentially lead to undesirable tax consequences for investors. Now, the Investment Company Institute, representing asset managers, warns that overly stringent regulations could dampen returns for millions of U.S. passive investors. And so this kind of highlights some growing scrutiny on large asset managers as their influence has started to expand. I just mentioned at the top of the show how we're nearing $200 billion in equity inflows. Where's a lot of it going? Passive investment. And so this regulatory shift can certainly redefine the operational landscape for a lot of these index funds. But more than that, it could alter the strategies, the passive strategies, and make them far more costly, both in lost return and in operational expenses, than they've ever been. Now, I'm Luke Guerrero, and this completes another InvestTalk program. We thank you for listening, and we encourage you to tell your friends and your family members about our free podcast downloads, which they can get at iTunes, Google Play, and Spotify. And make sure, if you check us out on iTunes, to rate and review us. If you love listening to our show, try watching it over on our InvestTalk YouTube. That's InvestTalk with 2 T's. Independent thinking, shared success. This is InvestTalk. Enjoy your weekend.
Hey everyone, if you enjoyed this video and want to see more amazing content, make sure you hit that subscribe button and turn on notifications.
Your support means the world to us and helps us create more videos that you love.
Subscribe now and join our community of savvy investors.